Oh, my friends, so I'm listening to a Faber podcast, his most recent one, where he talks about 2000. He did a paper, I guess, in 2016 or something like that. I forgot what it was, but he said if you followed the CAPE ratio, you would have missed 961% return by getting out of the market in 1993 when the CAPE ratio was high. And he quoted some hedge fund manager, which he says is one of the best hedge fund managers ever, who said, get out of the market now. Is actually interesting. I might try to go back and read this guy's article because it's literally the exact same stuff people are saying now. Cash isn't paying anything, so people are searching for yield. Don't be a yield pig, blah, 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 blah. It's like literally identical to what you hear today, what we've been hearing for the last, I guess since 1993. Anyway, it's interesting. So Meb says he uses a analogy of people saying the CAPE ratio is flawed to a guy at a poker table, a blackjack table, where he's been drawing a 10 and a 9, and he asked for a hit. And even though that's insane to ask for a hit, and he gets it, he gets a 19, and then he gets a 2. Even though the odds were stacked high, like odds were incredibly, like whatever, I don't know what the odds are, 3% that he'd get a 2, and 97% he would have gone over, whatever it's called, when you go above 21, whatever it is. And so his analogy is, that'd be like saying if because you made 961%, and from 1993 to the end of 2018 is as similar as taking a hit when you have 19 at the blackjack table. And I find that incredible that Meb would make that elementary mistake. I'm sitting there thinking, to invest in the market when it has a high CAPE ratio, to equate that with taking a hit when you have a 19 on the blackjack, to use that as an analogy is incredibly silly to me. I just sit there and say, what? That's the weirdest analogy I've heard of tons of weird analogies, and I don't want to say the weirdest one, but it's just odd. All right, so you have a 3% chance of success. Well, I don't even know what the odds are, but we'll just say it's a 3% chance of success, because you can figure it out mathematically. It's not hard to do. And winning at the 21 at the blackjack table, but you have a 97% chance of losing your money. The problem with investing is it's not a win or lose scenario. It's a win or win more, or win not at all by going into the cash, or a little bit by going to cash, but it's not a win at all costs or lose at all costs. It's not like that. There are companies that I just come back from Costco. I don't know if Costco's on the S&P 500 or not. I presume it is. But there are companies who are making money consistently year over year over year in which you're investing in. You're not investing in a stock. You're investing in a real life company with real life human beings that are making real life profits. It's not a gamble. It's not the same as taking a hit when you got 19 at the blackjack table. That you have a 3% chance of winning and a 97% chance of losing. I'm sitting there thinking, that's a mind-boggling, just elementary, infantile analogy to use. It's weird. I know what he's trying to say. What he's trying to say is, look, the guy who took a hit and he got a 2, so he got blackjack. He's like, see, I told you I was going to win. And that's like saying the guy who, just because you made 961% in the CAPE since 1993, it's like the same thing. It's not. It has nothing to do with one another. Investing in markets that might be expensive relative to historical norms, but are still making money. And then secondly, I'm sitting there thinking, maybe I got Meb wrong. Maybe he isn't as I don't know. I don't know what's going on. I'm sitting there thinking maybe I've given him too much of the benefit of the doubt, because I'm thinking that's just an insane analogy to make. Because you're not investing in companies that if you win, if they make more money, you make more money. If they don't make more money, you lose money. There's no correlation there to a gamble. Anyway, and secondly, on top of that, he uses, like, if you would have invested in 10-year treasuries, you would have averaged 8%, whatever it was, where the stock market averaged 9. I don't know what it is. I think the stock market averaged 9.5, and the long-term treasuries averaged 8. And he says, see, you would have got half the rate of return of the treasuries as you would have got in the stock market with a whole lot less volatility. But he says that on a year-over-year basis, it was like 9% to 8% to like 5% for intermediate term treasuries. All right, so that in of itself, that sounds like you would have done better in long-term treasuries than you would have done in the stock market with half the risk. And I don't know, literally, I do not know what the returns were. I just know he's using a 951% return relative to, I think he said 450 in the treasuries. I don't know what that'd be compounding, but I just know at the end of maybe that is compounding, but I don't know. But I just know at the end of the day, 9 versus 8 versus 6 sounds like not much of a difference there on any given year. That's true. Compounding over time for 25 years, that 9% versus 8% versus 6% of whatever it is a huge deal. Huge. And I'm sitting there thinking, look, all you got to do is I start with $100,000. I got 9. I don't know. It might be the 9%, 9.5% gave us a 950% total return, and the 8% gave us a 450% total return. So you say $100,000 times 950% equals whatever that is. $100,000 times 450% equals whatever that is. That's a hell of a lot different than just a 1% year-over-year return difference. That is real hundreds of thousands of dollars potentially. And again, I don't know because I don't know the numbers. I'm just listening to it on the way to Costco. And I'm sitting there thinking, this is so elementary. I'm actually, I don't want to say disappointed. I'm surprised how elementary this is. And so you can easily make the same thing. Well, the CAPE ratio is still showing way high. Why are you investing in the market now? I just, the whole thing is just, and then looking at what I liked about NetMeb is he talks about you can't look at historical numbers to extrapolate any detail from going forward, which is to include the CAPE. He's saying valuations, this is why I like Meb. He said valuations mean something. The higher the valuation, the lower historical the rate of returns have been. Well, in a vacuum, that's true, but you got to look at it relative to everything else that's out there and relative to what the 10-year other bonds are paying. You got to look at it to everything. Real estate, historically high valuations meant less return, but historical bonds are a hell of a lot higher than they are now. Historical real estate prices were much more depressed than they are now. So I don't know how you extrapolate that past into the future. I don't know. So all I know is I look at earnings. Is the S&P 500 making money or not? If they're making money and they're paying a dividend and they have cash on the side in order to keep paying the dividend, the payout ratio is low. They're not taking on debt to pay off the dividend. That's all you can look at, and that's all you can assume that is what you're investing in. A company that's making money. The past be damned, it means nothing. You're investing in a real, live, breathing company with real human beings. You're not investing in a blackjack table. You're not investing in roulette. You're investing in a company that's serving consumers or whatever it is that is making money or not. And if you spread your investments over 500 companies in America that are all making money, or some won't, some will go bankrupt, but others will stay, some will go off the S&P 500, others will be added. I mean, I don't know how you can compare that to a blackjack table. I just don't know. I don't know how you can compare that to historical norms relative to bonds paying 5 and 8, or whatever the long-term treasury was. I don't know how you do that. And secondly, I don't know how you look at it, compare the long-term treasury anyway, which had the biggest bull run in the history of mankind from 1982 to 2011. So starting in 1993, starting in 1993 to 2018 was a boom time for bonds, long-term bonds in particularly. That's gone. We're not going to get that kind of return. And then on top of that, you had two of the biggest recessionary environments for stocks that we've ever had. Anyway, what does that mean? I don't know. I just know at the end of the day, for me, stocks, because they make money, they have earnings, they're taking on less debt, and these are not like you're investing in a crapshoot. They're not like you're investing at the tables. All right, we'll see you.